to do if you're sitting on a huge gains? Probably a good problem to have, but one that many might indeed be dealing with, given how far the market has run. Steve Sears joins us. He's the author of the Barron's article this weekend of that title, What to Do If You're Sitting on Huge Gains. He's also the president and COO at Options Solutions. Steve, we got like 5.5 minutes. So I want to make sure we use our time wisely here. What was the main point you wanted to convey in this article? What do you do if you've got big gains?
The main point in the article is that you can swap out positions and use options as stock surrogates. You don't really give up any of the upside, but you eliminate a lot of the risk on the downside.
Now, you do that through what kind of options? Or you say stock replacement. So you hold on, and are you creating synthetic kind of stock positions? Or
no, it's a totally simple, plain vanilla trade. Pick any stock in your portfolio that you own where you think the gains are substantial, and say you dramatically outperform the stock market. And you think that the thesis is still bullish, and you don't want to give it up, but you're a little concerned that the stock has run a little hot a little too quickly. So all you would do, it's very simple. You'd log into your trade machine, you would sell the stock at a profit, you'd lock it, and then you go into the listed options market and you buy a call that expires in anywhere from, say, 6 months to a year on that stock. Most people will pick a strike price slightly higher than the stock price. So say, hypothetically, the stock is at 50, they might buy a call with a $55 strike that expires in 6 months. That's simple.
Okay. Now, do you decide strikes, or how do you kind of think about the either strikes or the expiries and how much you want to spend based on, say, what you've got? If you've got 10 grand locked up in a stock that you are using as an example, what do you think makes sense from sort of your, obviously it depends on your own risk tolerance and things like that, but what do you kind of have in mind, Steve?
Well, the beauty is really very much in the eye of the beholder, but let's just say hypothetically, you sell the stock and you lock in $25,000.
Okay.
And say that was 500 shares. Most people would look to buy 5 contracts, which is the equivalent of 500 shares, and they would look to maximize the time of their exposure and minimize the expense. So by that, you look out over 6 months to a year. The more time until expiration, the more expensive. So a way to lower that is to take an option. So the stock is at 50. You would pick let's say a January 55 call.
Okay.
So it's 5 points out of the money, and you would simply seek to replace that which you had sold.
Got it.
And that's it. Now, because options cost less than stocks, by definition, the $25,000 that you took in order to cover that with options might cost $6,000.
Right.
$5,000 for easy math. So you got $20,000 of dry powder, which you can use to diversify, buy yourself a present, do something nice for your family, stuff like that.
Yeah, that's the part that I like about it, basically, is because you can still have that exposure, but what you does free up that capital, right? And then you can do what you want with that. So thinking about, let's say you've got some free capital. When you look at this market right now, Steve, a VIX, it's at 20. Options prices that generally still fairly elevated, right? We can't break through that 20 on VIX. Walk me through what kind of opportunities you see or what you think about the dynamics here as we're sitting near highs in the S&P, but you've got this crazy rollover happening in some people's favorite stocks. I mean, basically, give me your macro take here into the close, Steve.
My macro take is basically the same as it's been for the past year. As long as interest rates are low, and even with the 10-year yielding 1.75-ish, they're still pretty low. You want to be constructive on stocks. What a lot of people are doing is you're seeing a rotation out of the hot sectors, the FANGs, and they're going to the beaten up sectors that'll benefit from an economic reopening. That's a huge trade right now, and that's roiling the market in any given day. Now, there are 2 other things that people are talking about: infrastructure trades and even the ESG. And people are looking to put money into those 2 sectors as well. What's unusual, I think, right now is that the money is so hot and people are looking to take profits. People are taking profits, and you're seeing a lot of this intraday vol as a result. So yes, the VIX suggests that there's complacency or not much fear of the future, and I think that's probably accurate. But what happens is if you get down to individual options levels, and you can pick almost any stock in the S&P 500, and what you're going to see is that the options are a little juiced. Why? Because of the Reddit phenomenon. So many people are buying call options right now as proxies for stock that it's increasing the volatility. So you got to be a little bit careful with what you're doing.
Okay. Hey, Steve, always like to get your thoughts here on how to handle real situations for traders. Always helpful to our audience. Appreciate you joining.
You bet. Thanks so much.
Thank you. Steve Sears joins us. He's an author, of course, for Barron's, as well as the president and COO at Options Solutions.